So, week 2, tools for monitoring risk. And the intro is just going to be um, kind of going over what they are, why they're valuable, and then we'll be going over some actual actionable tools you can use to improve your trading. And then we're going to be going over how to use those risk management tools to stay within your defined risk parameters. So let's jump into it. I don't know if you guys are familiar with Paul Jones. He's a hedge fund manager. He's a trader. He's a billionaire. This is what he's done for a long, long time. And one of the quotes from him that I really appreciate is, the most important rule of trading is to play great defense, not great offense. And as a risk management coach here, you can imagine that is exactly where I align. And that's exactly what I'm trying to teach you guys as well. Truly, you could have the best strategy in the world for trading, but if you are not managing your risk properly, it will not matter. You will lose your capital. So the importance of risk management is crucial to protect your capital and ensure long-term profitability. We know that. We won't go over it too much. So let's jump into the actual tools that we use, pretty consistent. So number one, I don't hear a lot of people talking about it in this Discord and other Discords alike, is a position sizing calculator or multiple calculators. And this is what I use oftentimes when someone comes to me asking specifically about their risk management plan and what they want to do to help, kind of figure out what size they're going to get into on a 2,500 drawdown or a $5,000 live account. So if you guys just Google future position size calculator, they're super valuable, and I'm sure you guys can figure out what they are. It's pretty nice because you can put in your exact drawdown, which would be essentially your liquidity, or you could put in your actual capital in your live account, determine the percentage. So oftentimes we'll ask you, what percent do you want to risk on this account? And you would say 2%, 3%, 4%, 5%, whatever it is. And then it would tell you exactly what that risk parameter would be. So it'd be like, if you were trying to risk only $200, be like 2 micros for a 50 tick stop, whatever that might look like for your account. But I highly recommend jumping on if you want to optimize your risk management plan, or if you don't have one yet and you want to start one, just look up on Google really quick the future position size calculator. And a lot of them will, and I can send you guys out a link as well to one that I use. And they're really nice because you can look up the actual future that you're trading because of the cost different. Each tick is going to be different for different, like NQ, or for different futures or commodities or whatever it is you're trading. So the ticks on ES and NQ is $5 per tick for a mini and 50 cents for a micro. So if you're trading something other than those two, you can punch that in and it will tell you exactly what you're trying to trade. So pretty straightforward. But the reason I wanted to emphasize on that a little bit more is just because I don't hear that talked about very often, and they're pretty useful. So moving on is, obviously we have our stop loss orders for our risk management tools. And the reason I want to touch on these, we all know them. Every single broker that I've ever used has a stop loss of some kind for futures. And the reason I'm touching on it is because it's often overlooked as a true tool of risk management. And I say that with some context because oftentimes we'll throw up a stop loss and we're like, okay, 50 ticks is solid. That's kind of what my game plan is. I'm usually in 1 or 2 lots, and this is what makes sense for me. But if you're truly developing a strategy to become the most consistently profitable trader you can become, your risk management plan has to be followed to a T. So that stop loss order, you should already have that placed or know where it is going to be placed before you even enter the trade. And that's the reason I want to emphasize it, is because oftentimes we're really only looking at the upside of the trade, and you jump into it and then you go to find your stop loss and it's a bit wider than you had expected, or there's no strong level below you at all or relatively close. So again, we're just trying to emphasize what tools to use for your risk management plan, and your stop loss should be known before you even jump into the trade. Same with your position. That's why the position sizing calculators are super beneficial. And then lastly, probably the tool I use most in my real-time trades is going to be your risk to reward ratio on TradingView. I'm sure most of you guys, if you use TradingView, you're familiar with them. The tools are called the long position and the short position in TradingView. And essentially all it is a risk to reward ratio calculator. And so it just compares the potential profit versus the potential loss of that trade. And it gives you out, 2-to-1 on your trade or your risk to reward, or 3-to-1. And I don't know if you guys, let me see. Oh, I put it in John's lessons. If you guys jump over there, I'll link it really quickly. So if you click on that link I just sent in the chat, it will pull you over to my tab, and you can check out that calculator that I sent out earlier today. And this is a risk to reward and your win rate, and it kind of walks you through in a really visual way exactly what trades you should be aiming for based on your win rate. So again, when we're trying to optimize our risk management plan, charts like these are super beneficial. So I highly recommend checking out that chart, and I will link it in my YouTube as well. So back to it. Hey, what's going on? How are we doing, guys? Those are the main tools that I use. There's a few real-time risk monitors, and they come in all sorts of shapes and sizes, like the VIX, for example, the S&P Fear Index. What it's essentially telling us is how volatile the market's going to be. And often you can play it in reverse. It's going up, market tends to go down, vice versa. But you can also use that as a volatility index. And that is just another reason that you should be staying vigilant in the market, is because these real life, and I don't know if you guys use Thinkorswim, there's a few other platforms where they calculate quite a few things like the VIX and Open News, and like if a FOMC is coming out during the day, it will typically put like a red flag up and say, hey, you're going into a risky trade just because this and this is coming out. So I don't use any real-time risk calculators, and the reason being is because often I kind of play into the idea that a lot of these massive firms are kind of banking on people to do what they expect them to do. So I think those can be sometimes manipulated. But what is important is to stay extremely vigilant when you're trading. And when I say that, I'm emphasizing news and staying up to date on what that is. So if you guys don't know what websites to go to, Jojo goes to a few that I can link in the description. I use the same ones for the day-to-day news stuff. But what I also do in the morning is I'll jump on Bing, I'll jump on Google, I'll jump on Microsoft, and I'll search in today's market news or trading news and just see everything that pops up relative today. And then I'll filter it through most recent. And that way, no matter what's coming out, at least I have a general information on exactly what might affect the market on a small scale and a large scale. And then I can just plug that into my day-to-day risk and make sure that there is no market affecting news like JB and Jojo put out daily. And again, these are just tools in our toolbox that we are going to be able to utilize to optimize our risk management strategy. And like good old Paul Jones said, the most important rule of trading is to play great defense, not great offense. So let's move on from the tools. And I told you guys it's going to be a quick and concise lesson, and we are coming to an end. I have 2 more points here. Using risk management tools to stay within defined parameters. So we touched on it a little bit. I don't know if you guys are familiar with Alexander Elder, Dr. Alexander Elder. He was the author of A New Trading for a Living, a pretty famous guy in the trading world. And quote I threw in from him today was, the goal is to trade well, not often. And that's kind of what I've been adopting recently. I'm looking much more into longer term trades instead of the scalping that I used to participate in. And the only reason I'm doing that is because oftentimes when it comes to scalping, I always saw my risk management plan being changed or manipulated almost on a daily basis. And the reason I don't want to do that anymore is because I know how important that risk management plan is. And so the easier you make it for yourself to follow your risk management plan, the better trader you're going to be overall. So in saying that, that's why I'm aligning more with what Dr. Elder said. The goal is to trade well, not often. So I'm kind of adopting a different trading style as of recent, looking at more long-term trades, holding for a couple days, couple weeks, couple months. And there's a few traders that are also adopting this, that I shouldn't say are adopting, they have adopted this. And the goal is for them to make, multiple six figures or even seven figures off of, maybe a dozen trades during the year, and maybe even less. And that's what I'm trying to get into, is using technical analysis on a larger time frame, following my strategy and my risk management plan to a T. And then after that, those trades are completed, going back, journaling down what I could have improved on, and then changing my risk management plan instead of changing it on a trade to trade basis because you're scalping so often. And I'm not saying you can't make money scalping. This is just something that I have found to work better for myself, is look towards the long. Hey, what's up, Matthew? Looking towards the long-term goals of what I want to accomplish in the trading market. So when it comes to adapting to market conditions, as you guys know, when news comes out, volatility comes into play. And this is going back to the point I made about staying vigilant, staying on top of news, paying attention to everything that's going out. JB and Jojo do a wonderful job of keeping you guys up to date on news. But again, we're trying to make independent traders here at Eternal Exchange. And so you guys are going to need to adopt these same habits of staying vigilant, staying frosty in the market, and really paying attention to what's going on around you. And on a practical sense, what does that mean? It means not trading during typical trading hours for yourself. Like if you trade in the first hour of market open, pay attention to news. I know this stuff sounds super basic, but this is a reminder to a lot of us who have forgotten our basics and our fundamentals, who you have hot and cold streaks where you're like doing super well for 2 months and then you can't even pass an eval 1 month. And I would attribute that almost completely to your emotional prowess, what your emotions, or what you're allowing your emotions to affect your trading. And I would also attribute that to your risk management plan. So when we're talking about adapting to these market conditions, all I'm saying is that you guys need to stay on top of the things that are going on in the market and what can affect it. So last point in this category is maintaining discipline. If you guys were here for last week's psychology class on Thursday, you guys know I mentioned David Goggins quite a bit. He, for me, is a extremely motivational figure in my life for adopting a more disciplined lifestyle. And here's my 2 points I have on discipline with risk management and applying these tools is sticking to your risk management plan, especially when you're emotional, is crucial. Tools like stop loss orders help enforce discipline by taking emotion out of decision making. So instead of, like I was saying earlier, how we will often change our stop losses based on the trade and exactly what's happening to us right now, how we're feeling, and seeing how that affects us. What I would instead encourage you guys to do is become extremely diligent and lay out a very structured plan to your trading. Wait for your setups to come into play, execute, and exit without letting any emotions affect you. I know it's basic stuff, guys, but this is a reminder to a lot of us who have forgotten the fundamentals of trading. And I had to throw in a quote by David Goggins. Again, I think this is very applicable to our day-to-day trading styles. You have to learn to be your own coach. You have to discipline your mind to stay focused on your goals, even when things get tough. Pretty straightforward, guys. All right, I have one more point for you. Like I said, I try to make these classes quick for you and provide actionable steps to improve your trading. So back to our first quote that we talked about from Paul Jones, a billionaire hedge fund manager. What he's famous for and how he made a living is emphasizing on preserving capital and using tight risk control to avoid any big losses. Makes sense, right? It's pretty simple stuff. You can look to the best traders in the world, and almost every single one of them will tell you that the most important rule to trading of any time scale or any commodity or any future or any stock or any asset is going to be your risk management. And a quote from Paul Jones is, "Don't focus on making money, focus on protecting what you have." I think that aligns perfectly with what we're trying to teach here, is because, and here's a real world example. I don't know if you guys were all here for last week and watched Joe trade. They were losing days the whole week. And now here we are 2 days into the trading day, and he made up every single loss of last week. I think it goes to show, if you really focus on that good defense and not on the offense, you guys have a much more likelihood of making profits in the stock market. And I can't touch on that enough. I mean, truly, if you guys just focus on protecting what you have instead of making money, it will make your life so much easier. And then lastly, this guy, Bruce Kovner, I don't know if you guys have heard of him, another famous billionaire hedge fund manager who is well known for trading. I got a couple points on him. He was known for adapting his risk management strategies based on market conditions and never risking more than a small percentage of his capital on any single trade. So again, these are people that I attribute a likeness to Warren Buffett. They're people who never went swinging for the fences on a trade. They were always extremely diligent about their plan and their set risk parameters and following them to a T. If you guys are able to develop a risk management plan, not only for your individual trades, but your overall portfolio and any finances that you bring into your life, if you know where those dollars are going and how to protect yourself from potential losses, and you focus on that, the gains will come naturally over time. It's the losses that really make a big difference. And again, I forget who this was by. I heard it the other day. It is really easy to make money in the stock market. It's hard to hold on to it. So it's pretty straightforward. I think all of us can align with that pretty well. And a quote from, to finish off this lesson, a quote from Bruce Kovner is, "Risk management is the most important thing to be well understood." I think that sums up today pretty well. I appreciate you guys for sticking along with me. Again, my aim for these classes is to be quick and concise and provide you guys with actionable tools to improve your trading right away. And sometimes to serve as just a simple reminder to those of you who already have a good risk management plan in place. And maybe you have forgotten, or maybe you stopped emphasizing it as much as you should. And these are some real life examples of some extremely well off or well to do people in the trading market who became billionaires, self-made, over 40, 50, 60 years of following strict risk parameters. So for me, it's pretty straightforward, guys. Protect what you have and don't focus on making the money. Let me read through the chat real quick. Would you like to come on EE as a trader as well? No, I don't think I'll ever trade publicly again. The stresses of knowing that no matter how much I teach someone, they're copying my trades exclusively and then losing. I mean, for an example, the stress that it put on me is back when I was a trader at Traders Evolve, I had I think he was 59, 58 at the time. He would DM me pretty often, just one of the guys from the trading group who saw us on Instagram, decided to join up, was new to trading, had never done it before. He ended up blowing nearly his entire life savings in a couple months trading. And knowing that no matter what parameters that we set and how diligent we were about telling people about risk management, the fact that I would get on and trade in front of people and knowing the stresses that came from, losses that I went out and did, it was a bit much. I know that's probably not fair to put on myself, but the stress was there nonetheless. So I don't think I will ever trade publicly again, but I will often share with you guys what is working for me, what has worked for me in the past, and what I'm focusing on in the future. But as far as the live trading and showing you guys exactly what I'm doing, I don't know if I'll step into that again. Matthew, John, for a person that has a new funded account, how do they go about raising their sizing without blowing an account? You don't. So you should not raise your sizing on an account. And I say that because I'm assuming you're talking about a prop firm account. So you have a set risk parameter that you're never able to breach in, let's call it $2,500. You should not be risking more than $200 or whatever your risk parameter is per trade, and figure out your win to loss ratio. Once you get over $10,000, $15,000, you can start to think about that. But that's never how I traded prop firms. What I used prop firms as is exactly how they would leverage the losers. I would leverage them. They were expecting people to buy a bunch of prop firm accounts, pass them quickly with no good risk management plans and aggressive trading styles, and then they would get funded, pay them a bunch of money, and they would blow the accounts and start it over again. What I did was move quickly through those initial evals, and then so I would play extremely aggressive on those initial evals, and then I would play extremely conservatively on those my actual live, or the funded accounts as they call them, and I would cash out as soon as I would hit my parameter to cash out. So whether that was $3,000, $4,000, $6,000, whatever it was, that's how I leveraged them, because I knew they were relying on emotion and bad risk management from everybody else, and I wanted to make money off them as quickly as they were making money off other people. That's how I found success in it. If you are planning to treat it like a live account and keep one open for a year or more, then you could talk about sizing up. But what you need to think about if you do want to size up is just always have that trailing drawdown in your mind behind you. So say you reach the required amount to where that stop loss is no longer following you. I would give yourself at least twice or double the initial drawdown before you start even thinking about sizing up. So if it's $2,500 and now you reached in the funded account $5,000, that would be your new zero. So your new zero is $5,000. Everything past that is profit for you. And if you come back to that, that's when you pull the plug and cash out, and you take that $5,000 and run. So I would get up to, let's say, $7,500, doing the same exact risk management plan and scaling size you have been doing. Take that, and now you have $2,500 to work with. If you are able to scale that beyond, then you can do whatever you want. You can play extremely aggressively if you want. Not something I'd recommend, but if you want to scale up, I would recommend just going with a bigger account size, plain and simple. The changing your position sizing almost never works out on these smaller accounts. And so I would just say either give yourself a very wide buffer or preserve that account that you already have and scale up on a separate account completely with, let's say, a $300,000 account. that's how I would go about it. Hopefully that makes sense. Thanks so much. These concepts are important to keep on top of mind. I need consistent reminder. Yeah, I think we all do. I mean, honestly, these prepping for these lessons are really beneficial for myself as well, because when you get in the habit of jumping on, you're part of a community. You guys jump on to this Discord, or if you're part of another Discord or multiple Discords, you jump on, see what everybody's doing, what the activity is. You have your little morning routine where you go through your charts and then you start trading. If you're not actively talking about or thinking about implementing your risk management plan and how to scale correctly and what you should be doing to optimize that risk management plan, it's easy to forget, and it's easy to kind of stray away from what you know to be right in the fundamentals. So it's super beneficial for me as well. So should your goal be to reach 10,000, for example, and take all your profit out and use that capital as your own in a live account, just so you don't have the prop firm rules holding you back? That's another great approach. I wouldn't take all of that and put it straight into a live account. What I would do is probably take a percentage for savings, the same way you would dissect your normal paycheck, some for savings, some for your entertainment budget, some for your bills, and then whatever is left of that, let's call it 7,500. Then I would take that capital and either apply that to more prop firm accounts, or you could even split even further and say $5,000 is for a live account, and the rest I'm going to be applying to prop firm accounts and applying those same strategies that I did to get that cash out on that $10,000, and apply that to now you have 10 accounts. And if you apply that to that, you can scale those prop firms exponentially. I was never able, or should put it this way, I was never at a point mentally where I was able to cash out on more than 5 accounts at a time. It was the greed that would set in on seeing that much money and knowing that I just cashed out on 1 account, and then 2 accounts, and then 3 accounts, and then 5 accounts. And then you sit there and you buy 10 accounts. I was at a point in my trading career where I was not able to emotionally deal with the amount of money that I was able to make on that. So that's why I would recommend, and I highly encourage, sticking to the exact same risk parameters that you were applying to get that initial cash out. Because truly, if I stuck to exactly what my plan was, let's call it 2 years ago, whenever I was with Traders Evolve, I could have made well over $150,000 in the stock market, for very, very minimal investment, probably less than $10,000 in, which is so crazy to think about. But that emotional game, and that's why I came on board with Eternal Exchange to really, really emphasize risk management and your psychology as well as wellness, because I know to be true, not only with myself from personal experience, but through everybody that I've witnessed trading, everybody I know that is profitable and consistent. These are 3 things that are placed above all else in my eyes, including technical knowledge on the stock market. And so that's where I'm here to tell you guys, like, the greed and the fear are so real, and just because you have a couple more zeros behind your account, that fear and greed will only multiply. So your discipline and your risk management will matter more and more as you progress through your career. So that's why I emphasize this stuff so much. I know it sounds redundant and I know it sounds so basic, but it is so fundamentally important to your trading career. That's why I came on board. That's why I'm teaching this. That's why I'm no longer teaching trading online and doing live trades for people. This matters more than everything else in my eyes. So hopefully that makes sense. I know I went on a bit of tangent to answer that question. What is the ideal account size for a prop firm account as a trader? It depends on the platform rules. I believe, someone correct me, I think the 150K on Apex, they probably changed their rules since last I got an account from them, but I think 6 months ago, 7 months ago, that was the best account to get in my eyes as far as the drawdown versus the profit goal. And just because the ratios worked out better than anything else, it was closer to a 1-to-1 than you could get to anything else. It's like blackjack at the casino, like that's the best odds for yourself. That's what the 150K or the 100K was at Apex. But I don't know, you have to look at what the drawdown is, what the profit goal is, and then what the rules are surrounding that. So you're gonna have to do your own research, but I definitely recommend looking into multiple prop firms to see what rules you align with the best, and then within that prop firm, find which account size makes the most sense as far as risk to reward ratio. I know this may be contradictory, but could you also have a live account out of those 10 that you trade heavier on? Full port. Yeah, you could. Well, that's kind of what I was touching on earlier. I wouldn't say full port, because full port is one trade for the entire account. More aggressive, yes. I would say, maybe 10% of the risk on those aggressive accounts, but I don't think now I would ever go over 10% on a single account unless I got the account for free and it was one of those perfect setups, and there's zero risk applied to you financially. But you also have to be aware of, it's not just financial consequences that we face when trying to develop discipline. There are also mental consequences that oftentimes are subconscious that we're not aware of. When you go out and trade this one account that way, you're teaching your mind, this habit forming machine, that this is something that's okay. So as long as your discipline is on point and you're well aware of those mental consequences as well, sure, you could full port a free account one time, but I wouldn't recommend it, to be honest. And even though extremely aggressive evals that you're playing, still, dude, 10% is like max. Honest money, man. I appreciate that. Yeah, oftentimes when I'm prepping for these lessons, I'm like, dude, it's like this stuff is so basic. I go over it all the time, but then I have to remind myself, I was like, this is why you're doing it. I was like, this is the stuff that matters, no matter how fundamental or basic it is. It's like our ABCs. We're taught the alphabet in kindergarten and first grade, but we use it every single day. It's like, that's the important stuff. That's the stuff that matters right there. So appreciate that. My funded future offers the same features as DD with no trailing. Nice. Yeah. The trailing they have no trailing in general, or no trailing unrealized profit, because unrealized profit trailing is the only reason I had a problem with Apex, but they have to make their money somehow. I understand why they do that. Thanks for the session, John. I'm going to head out. Enjoy the rest of your day. I have EOD trailing. Gotcha. Well, cool. Alrighty, friends. Hopefully that wasn't too long for all of us. I know most of us got in here a little bit later, but again, remember your fundamentals. Use these tools that all these platforms have for us to use. Like go Google the position sizing calculator if you don't have a risk management plan set up for yourself, or you want to optimize it. Use the stop losses not as places to make sure you don't get totally burned on your account, but as part of your risk management plan, saying this stop loss cannot move because this is what I'm risking. This is a 4% of my account that I'm risking, or 3 or 2%. And that risk to reward ratio, I know it's simple, but like the chart I sent out, and looking, if you win only 30% of the time, but you go for a 3-to-1 every time, you're going to be profitable. So keep that stuff in mind, guys. These fundamentals are the building blocks of something so important. And so yeah, that's why I do this, guys. Appreciate you guys a ton. Hopefully you guys can take some actionable steps to improve your trading journey through what you just learned today or were reminded of. So appreciate you guys a ton, and I hope you have a fantastic day.